All right, let's dive straight into this explainer. We're going to put Intuit through the absolute ultimate valuation gauntlet. As an investment analyst, I love doing this, taking a severely beaten down stock and stress testing it using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. Plus, we'll run a rigorous discounted cash flow and some alternative models. Basically, we're going to figure out, is this massive market drop a huge warning sign, or is it literally the opportunity of a decade? Here's our roadmap for the gauntlet. We'll start with a quick snapshot of Intuit, then move right into the Buffett and Lynch lenses. After that, the Benjamin Graham lens, our DCF valuation analysis, alternative models, and finally, we'll wrap it all up with the synthesis and final verdict. Okay, Section 1, Snapshot. Intuit Inc., a dominant platform on sale. So Intuit is currently trading right around $267. Now, that is a massive 67% discount from its 52-week high. Usually, when a stock falls off a cliff like that, the market is pricing it as if the underlying business is completely broken. But as we're about to see, the actual data tells a completely different story. First off, Intuit isn't just that seasonal tax software company you use once a year anymore. Look at this lineup: TurboTax, Credit Karma, QuickBooks, MailChimp, the Intuit Enterprise Suite. They've built this incredibly sticky, comprehensive financial platform that powers consumers and small businesses year-round. Seriously, once a business is plugged into QuickBooks, trying to leave is roughly as appealing as getting a root canal. And you can see that stickiness in the financial momentum, which totally defies the stock crash. Just look at their Q3 fiscal 2026. Total net revenue actually jumped 10% to $8.5 billion. Zoom out to the first 9 months of the year, and revenue is up 14% to $17 billion. Plus, net income up a staggering 20% to $4.2 billion. The business is fundamentally growing while the stock is crashing. It's a fascinating disconnect. Right, let's move to Section 2, the Buffett and Lynch lenses. We're looking for moats, management, and growth at a reasonable price. Looking through the Warren Buffett lens first, Intuit passes with absolute flying colors. Buffett wants a wide economic moat, and Intuit's ecosystem has ridiculously high switching costs. Earnings are consistent and growing. How about debt? Totally manageable. They're sitting on $6.78 billion in cash and investments, which easily wipes out their $6.16 billion in total debt. And with an exceptional return on equity of around 20% year-to-date, based on $20.6 billion in equity, yeah, Buffett would absolutely see a wonderful company trading at a wonderful price here. Now, to shift gears to Peter Lynch, we need to quickly talk about the PEG ratio. This is the price-to-earnings ratio divided by the growth rate of those earnings. For Lynch, this is the holy grail for finding growth at a reasonable price. And basically, any PEG ratio below 1.0 means you're looking at undervalued territory. So, applying that to Intuit, they fit Lynch's stalwart category perfectly. A big company that's still growing fast. If we take their $267 price and divide it by a conservative forward EPS estimate of $23.80, we get a historically cheap forward PE of about 11.2. But here's the kicker. With earnings projected to grow between 15 and 18%, Intuit's PEG ratio lands squarely between 0.62 and 0.74. For Peter Lynch, a PEG that far below 1 makes the stock a screaming strong buy. Okay, Section 3, the Benjamin Graham lens. This is the uncompromising math of the defensive investor. Benjamin Graham is notoriously strict. He starts with a defensive quality checklist before he even looks at the price. But Intuit clears it effortlessly. Adequate size? Pass, with over $17 billion in year-to-date revenue. Strong financial condition? Pass. They've got a super healthy current ratio of 1.5 to 1, ensuring deep liquidity. Earnings stability and a solid dividend record? Pass and pass, with consistently positive net income and $3.60 per share declared year-to-date. But having a good company isn't enough for Graham. He demands statistical cheapness. His intrinsic value formula is brutal. You take his constant of 22.5, multiply it by that projected EPS of $23.80, and then multiply that by the book value per share, which we calculate at $74.74, based on their $20.6 billion in equity across 276 million shares. You crunch those numbers, and Graham's intrinsic value comes out to roughly $200.05. What does this mean? It means at the current $267 price tag, a strict Graham investor wouldn't touch it just yet. They'd demand a wider margin of safety and wait for the stock to drop below that $200 threshold before buying in. All right, moving on to Section 4, DCF valuation analysis. Time to project those future cash flows. We're going to build a standard three-step discounted cash flow model. We forecast the free cash flows over the coming years, calculate the terminal value for the company into perpetuity, and then discount all of that back to today's dollars using our weighted average cost of capital, or WACC. Now, since the 10Q doesn't hand feed us explicit WACC or terminal rates, I have to state some standard but very conservative assumptions here to fill the gap. We're using a baseline free cash flow of about $6.4 billion, extrapolated from their year-to-date operating cash minus investing activities. Then, we apply a standard tech discount rate of 10% and a terminal growth rate of 3% to align with long-term GDP. Check out what happens in our sensitivity table. Using our base assumptions, a 10% discount rate and 3% growth, the fair value spits out at $350. But here's what's really wild. Even if we get super pessimistic and use an 11% discount rate with just 2% growth, the fair value is $275. That is still higher than today's $267 share price. The DCF models strongly suggest the stock is undervalued right now. Section 5. Alternative valuation models. Let's quickly look at multiples and Wall Street consensus. From a relative valuation standpoint, the disconnect is just staggering. Right now, Intuit's forward price-to-sales ratio is 3.12. The broader industry average, 6.39. Let that sink in. The market is pricing Intuit at less than half the multiple of its peers, even with its premium moat and massive margins. And when you look at consensus targets, the gap gets even wider. We're sitting at $267 today, right? Well, the ticker mid-case valuation model projects a fair value of $444. And the Wall Street mean target, they're implying an 84% upside, putting the stock at $491. So Section 6, Synthesis and Final Verdict. Did Intuit actually survive the gauntlet? Let's pull it all together. The results are amazingly consistent. 4 out of our 5 frameworks, Buffett, Lynch, the DCF model, and relative multiples all scream buy at current levels. The only outlier is the ultra-conservative Graham formula, which tells us to hold and wait for roughly $200. But from moat analysis to modern cash flow projections, the math overwhelmingly points to upside. As an analyst, my final verdict here is a solid buy at $267. Look, there are risks, for sure. They have high revenue concentration around tax season, and broader macro headwinds can squeeze small and medium businesses. But you're looking at a wildly sticky business pumping out 55% EBITDA margins and billions in free cash flow. This 67% haircut just looks like a massive market overreaction to temporary fears, plain and simple. We've run the absolute gauntlet today, from Buffett's qualitative brilliance to Graham's uncompromising math, all the way through a modern DCF. But investing is deeply personal. So here is my final question to you. Based on the exact models we unpacked today, at what price does this stock trigger your personal margin of safety? Run the numbers for yourself, and I'll see you in the next explainer.